The best thing I can say, when you start in this business, if you want to raise money, you got to start raising money yesterday. So it wasn't, I found the deal and I just started calling people for money. It was when I made the shift into multifamily, I went through all my contacts, right? I take my phone, I test people. I go to your phone, go A to Z and put a dollar amount next to everybody. That's something that anyone listening to this podcast and hear me say that, every single person can do that once they get done with the podcast, or actually get off the podcast and do it. You put everyone's name A to Z and put a dollar amount, right? And then you'll come up with a bottom dollar, even if it's $5, it doesn't matter. And you'll say, okay, look, $1 million. Now you got to educate that database. You got to educate them so they know you're an expert.
This is episode number 18 of Multifamily Success Stories podcast. Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
and Julian Sage,
and welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, deal makers? Julian Sage here. And in this episode, I had the special honor of speaking with John Cohen, co-founder of Toro Real Estate Partners, a multifamily investment company that started in 2015 and has since scaled to $250 million of assets under management and 2,700 units spanning across Florida, Ohio, South Carolina, a lot of the southern and Midwest states. In this episode, John shares his story of flipping distressed properties at tax auctions for sometimes $500 a house, and how he took that experience and rolled it into syndicating and flipping distressed multifamily properties that he likes to say are around D- no cap properties into profitable cash flowing assets. John also gives some great advice for capital raising and working with investors in this episode. Some really cool things that he shared that you definitely don't want to miss. But if you like my show notes for this episode, then go to multifsuccess.com/EP18. Or if you like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, deal makers, to another episode of Multifamily Success Stories. In this episode, I have the special honor of speaking with John Cohen. John, would you please introduce yourself to the deal maker community, let them know who you are, and what inspired you to get into multifamily investing?
Yeah, so my name's John Cohen. I'm the co-founder of Toro Real Estate Partners. Prior to the Toro days, my company was JC Property Group, which is a 50% partner in Toro Real Estate Partners. I've been buying real estate since 2009, and the transition to the multifamily side for me was I had a rental. It was a college rental. I bought a house for my brother and myself when he was in college, and we actually still own that house today. It's no longer rented to athletes. It's now rented to a family, but I always wanted I'll call it the passive income, right? The cash flow. And the path I took to get there was a little different. I started as a financial advisor. I hated that for, 3.5 years. I was working at Morgan Stanley, relatively successful. I was able to buy not only that house, but I also owned 150 properties in Pennsylvania, all bought through tax auction. Those were, buy, hold, buy, rent, buy, flip, just flip the paper. And it was able, it gave me the opportunity to do all that with all my own money, really no investors. And then the vision was always commercial real estate. My vision out of the box was take a warehouse, turn it into, a major condo development in Brooklyn and sell it. And that was the sexy part of real estate, right? Taking, a beat up warehouse or something different, turn it into a loft, something cool. And as I was going through the real estate journey, I got my license. I started doing rentals and sales, and then I turned that into commercial investment sales. I interviewed at all the big shops, all your Cushman, your CBRE, JLL, Marcus & Millichap. I interviewed everywhere. And the first interview I went on, I sat down and the guy said, well, why do you want to do real estate or commercial real estate? And I said, well, I want to make a lot of money and sell big buildings. Like, why else? And he basically said, I think you got a little bit of, you got to educate yourself a little bit more. Then you start realizing that, in the city, it's block by block, right? You can do office space on the Upper East Side between 70th and 80th. And that's it, right? You never deviate from that. So after all the interviews, I ended up sitting down at Mark Smilchap. I told him what I wanted to do, which was still the condo development warehouse. He convinced me, he said, what if you can make the same amount of money a lot quicker doing multifamily sales? I was like, well, I'm listening. And I thought multifamily 200, 300, 400 units. And then it ended up being, 6 units, 6, 8, 12. And I said, yeah, you got me. Yeah, right. I'm buying into this. And Mark Smilchap gave you the most flexibility. They have the best training program in the business. So the first year, Mark Smilchap, I was on a team that ended up selling about 26, $27 million worth of real estate. We did about 28 transactions, and it was, I couldn't have picked a better product. And then while I was there, I was still doing the stuff on the side. I had a fix and flip going on. I had my houses in Pennsylvania. And I just started talking to my clients and realized, like, after I buy and sell something, I'm done. Or after I buy and sell a transaction, I'm done. But the aha moment for multifamily, not the Dave Lindahl books I read or stuff like that. It was, we sold the same property 3 times in 1 calendar year, and every single person made money. And then the last guy that bought it, which was, we sold it at a sub 2 cap. I said, what are you going to do with this? And he said, well, this is what we're doing, right? It's completely renovated. It's done. I don't have to get any out stabilized tenants. I'm going to own it for the next 50 years of my life. I'll put some tenants in there and I'll cash flow forever and it'll appreciate. So I was like, okay. So I started questioning all my clients on the buy and the sell side and realized that, the consistency, the stability of multifamily is what I wanted to do. So I went out and I sent out a direct mailer and I got a 48 unit back. And I said, this shit's real, for lack of a better term. And I just went through the process that Mark Smilchap taught me. I had a mentor at the time, and I said, okay, hey, and I just went out and bought it, right? It was just took action and realized that's why multifamily made sense. And that was a 48 unit in Columbus, Ohio. And since then, we've scaled to, over 4,500 apartments, over like 26 transactions over the last 7 years. So it's been a wild ride. It's been a fun ride. I've made every mistake you could, and we've been relatively successful. So that's sort of the story.
Wow, lot to unpack there. So I want to, take that bite size. First thing that you mentioned was you were doing tax auctions and you scaled up to 150 properties. That's pretty sizable. And usually people, I feel like when they get, they're scaling and they're doing well like that, they're just like, okay, well, why change things? I've got a good thing going. Was that easy for you to be able to scale up to that size, and why deviate when you were having clear success?
So that's an amazing question, because while I was doing it, my Philly auction period, right? It was all done in Philadelphia. When I first went to the auction, it was, you could go there with cash and you bid on a house, and you gave them a 10% deposit or $500, whatever was more, right? If you bought a $3,000 property, you gave them $500. If you bought a $20,000 property, you gave them $2,000. You put 10% down, you had 30 days to pay the balance. There was less rules, I'll call it, right? Then it was, you needed bank checks, and then you needed an LLC. And if you didn't pay it in full, there was penalty. So it became a little bit harder. But when I was doing that, I was working a full-time job, and I tried with 5 or 6 people to hire them and train them on how to do that full-time and scale it. And nobody really bought into it. I was actually cleaning out my office the other day, and I was looking at deeds of properties that I owned, and I was on the phone with my buddy, and I was like, yo, put this address in, right? And I bought the house for, $16,000, and I sold it for $26,000. And I look it up online, and, the value is 84, right? So it's like, I should have held some of them, but for the most part, what I was doing was real estate gambling. I would get the list of properties. It's published. Philadelphia is an amazing place to start. 400, 500, 600 properties month after month. There's 5 auctions a month, or there used to be. I would get the list. I would analyze them at my house. So I'd download every property. I'd do my, 20% and this is where I want to be, get 3 values from Zillow, Redfin, whatever it is. Then I'd get in my car. I would drive to Philadelphia, 2 hours away, not far. And I would spend literally a day there just driving every single house. And then you weren't allowed to go in. You weren't supposed to go in, but you park your car, you walk around and you see what's in. Sometimes the door was open. Sometimes there was a tenant in there, and you did it. And then I'd come home. I'd say, okay, I want to buy these 10 houses. The next day, I'd get in my car, drive to Philadelphia, sit at the auction and bid. And sometimes you won, sometimes you didn't. But I would try and walk away with 2 to 4 properties per auction. Sometimes we got 10, sometimes we got 1, sometimes you got 0. And you put down your deposits and then you go to the houses that night. So at the end of the auction, I get out of the auction. I called my locksmith, which I'm not supposed to do. And we would go to the properties and we'd punch the locks out or we'd knock on them. Sometimes there was a tenant in there. Sometimes it was vacant. And I said, okay, I'm going to close on this one. I'm going to close on that one. I'm not going to close on this one. And then in that 30-day period, I'd call the neighbors. I'd call some local flippers in the area. Hey, you want to do this? And at that point, the titles were really messed up. So, there's a company called Tax Title Services, which people didn't know about back then, but they would clean the title for you. So I would bring it to people like, I can't buy that. It's a tax property. I can't get clean title. I'm like, I got you. Don't worry. We'll take care of clean title. And that's how I was able to sell a lot of them. And now there was some properties I bought, I opened the door and there was no floor. There was no ceiling. And I didn't even pay the balances on those and I let them expire. So at 150, it sounds like a lot and it is, but how many did we purchase? Maybe, 80% of them, maybe 65 to 80% of them, just depending on how many did we flip, 90% of them, or how many did we just sell the paper, 90%, how many did we retain and fix and flip? There was less, but I was just going in a different direction. I wanted to go bigger as opposed to doing that process of, back to Philly, drive back and forth. I tried to tell people, it's a 6-figure income, no doubt, but there were rough areas. I mean, there was times where I'd knock on the door like this because I never knew what was behind the door, or I'd be driving down a block and someone would throw a water bottle at my car. So it's like they were rougher areas. And when I would show people that, they would say, nah, man, like you're crazy. I'm not doing that. I had 2 friends that went to the University of Pennsylvania and I told them where I was buying property and like, you're going to get robbed in that area. I'm like, no, I'm not. Like, don't worry about it. We're good. So I think at the time it was probably scared a lot of people away because it was some heavy lifting stuff. But it was funny in October. I actually had on my calendar to go back down to Philly and see what it was about. But Corona and so it's something that I always had a passion for. It's something I'd love to do again. But it was a lot of work. When you look at the bottom dollar and what you were actually making on an hourly basis, it probably wasn't nearly as what we're doing now. So it was just. The scalability was there. I just wasn't able to put the team in place. It was also early on in my career. If I did it today, I'd probably be able to, set that up relatively easily with the right people. But it's just been something that, it's out there in the future if I wanted to do it.
So what was the spread or the profit margin that you were making just on those deals?
Yeah, so we had a really simple spreadsheet. I would basically go to Zillow, Trulia, Redfin. I'd put the address in. I'd see what they said the values were. I would look at the opening bid and I would basically want to be anywhere between 20 and 30 cents on the dollar. So if the house was, completely renovated and it was worth $50,000, I may offer, anywhere, less than $10,000 to buy that house. Cause I knew I have a large way to mess that up where it would still work. And at the end of the day, if I was trying to wholesale it or flip it, I knew, and your rehab value, you put it in by driving it, right? You'd look for things, like you learn things, like if the windows are fogged, maybe it was a burnout, maybe there was a fire, or you talk to the neighbors and like, oh no, you don't want to touch that one, right? So you pick up some tips and tricks, but we would typically be offering about 15 to 30 cents on the dollar.
And so after, after kind of this, running this, auction business and you were, building up this experience. And first thing, did you learn all of this just kind of, figuring out yourself, or did you have someone that was helping you?
Yeah. So when I started doing this, I actually, I'm a little stubborn and maybe a little hard-headed sometimes. So I was actually still a financial advisor. I was cold calling, raising money for, what we did as a financial advisor. And I just downloaded a book. It was like $400 on tax deeds. I read it. I said, shit, what do I have to lose? The first property I bought was a $350 property and it was worthless. And so I just, like I said, it was like real estate gambling. To me, it was my own money. There was no investors. If I bought something and it worked, great. If I bought it and I lost it, well, I learned so much through that process. So never had a mentor, never had a coach. Actually was utterly against it until I got into the multifamily world. And I'm not for it or against it now. I just tell people, if you have a foundation, a mentor will be gasoline to your fire. If you have no foundation, mess it up a couple times. Do it on your own, right? But because if you pay someone expecting to get results, it's on you. If you pay someone and take what they tell you and put it into action, then it's on the person that, I don't want to say it's on them, but that'll help. If you just expect to press the easy button, that shit doesn't exist. So you just got to be aware of that. But yeah, no, I learned, I was still doing it up until 2015, and I was 100% on my own dollar with very little education. I got excited about Philadelphia because I was on a rooftop in Manhattan, and the guy said I own like 300 properties. I was like, really? And he gave me like a packet like this, like you can buy any one of them. I'm like, $1,000. Like, how could you go wrong for $1,000? So it's just that's how I decided to get started. There was no method to the madness.
You know, I'm curious because John's got some experience in the home investors franchise. Doing finding these types of properties that are in rough situations and acquiring them. So what about a lot of people might that are in real estate, they think, oh, this is 150 properties, I've got a good thing going, and that's kind of where they stay. Why, where is the mindset shift from like, hey, I can really scale this business or continue to scale this business versus, you saying I'm going to pivot and do something completely different. You got your real estate license and then you ended up working at, Marcus and Millchap. So can you talk on that mindset shift or, where does a person
When I was a financial advisor, I was really good at raising money. So this is prior, the laws have significantly changed since the Jobs Act. So it's made life a lot easier for people like us. And I think the SEC actually just came out with even easier criteria to raise money. But when I quit that job, I called my dad, who happens to be an attorney, and I said, I have an amazing idea. I'm just going to cold call people, raise money, and buy real estate. And he said, yeah, you can't do that. It's not, it's not legal. And I was like, oh man. So that was disappointing. But I still always had that in the back of my head that, if I can go buy one property, if I have 10 people that want to give me money, I can go buy 10, 20, 30 of these things. So when I originally put my goals on paper, I said I wanted a $250 million investment business. And the Philadelphia stuff was working, but, the most expensive property we bought was like 23 or 33,000 bucks. It wasn't a lot of money. And to get to 250 million with buying $20,000 properties. And I was doing it all cash. There was no debt, nothing like that. So I didn't have to worry about any mortgage restrictions, right? On how many mortgages could you have and stuff like that. And I've never had a W-2 job in my life. I've never once worked on a paycheck on an hourly rate or a salary. Every job I've ever had has been 100% commission or eat what you kill. So I wouldn't have qualified for a mortgage anyway. I mean, and even today it's tough. It's still hard to do that. So everything did in cash. And I'm looking at that and I'm like, I'm going to need a ton of cash. So I said, okay, how can I get to that? How can I get to that level? And then it was, okay, that this works. And it could be a little side hustle. It could be something that makes a couple bucks, but inevitably it was taking that raising money ability and deal finding ability and hybriding them and saying, okay, if I'm going to raise $1 million, I can't go buy, 20 houses or 30 houses. It's just a lot of work. What if I put 30 houses under one roof? Or if I did, an apartment complex, a garden style apartment complex. And that was after reading a lot more books. And, I watched the Dave Lundahl webinar and sent out direct mailers the next day. And I realized, okay, that's significantly more scalable. And it came down to numbers, right? I don't really fall in love with our deals. It just came down to, if I can buy a property at a 5 cap and I can increase the occupancy or I can increase rent. If I sell it at a 6 cap, it's worth more. So it was just easier when it all came into play. The Marcus Millichap side helped dramatically because you underwrote. So you saw that I don't have to reinvent the wheel here. If I buy, and a lot of the properties we buy at Toro are dilapidated, messed up. So it's all right, well, if the property is 50% occupied, if I just fill it up, it's worth more money. What's it going to cost me to fill it up? It was math, which is, that worked for me. It just, the light went off and said, okay, well, if I can go buy 10 of those, well, that's 450 units at 45 units. I said, well, that's a lot better than buying 150 houses. So it just dawned on me, and it was always in there. It was always inside me. I'm super ambitious. To this day, I say, I want $1 billion investment business, and it's not $1 billion. I want a full service. Some guy comes to me and I want a full service investment shop. You can buy land, you can buy fix it, whatever it is. Whether we get there or not, we'll find out. But I always wanted bigger. I always want more, which is one of the traits about, satisfied? I'm really never satisfied, no matter how well we're doing or not. I always want more. I always want to go bigger. So we'll see. But it was always there. It was just a matter of, maybe it was Mark Similichat, maybe it was the webinar, maybe it was a book I read, but there was no one thing that turned it on and said, go buy multifamily. It was just, I thought it was the light at the end of the tunnel from, a little tax deed for $500 to, a multifamily complex for 30 million.
I think it's maybe easier for most people though when they're thinking like, okay, if I put in X amount of my dollars, I'll be able to get back X amount of dollars, and you can easily put that together. But when you say, I want, $1 billion of, assets under management or, play money to be able to go out and, develop land or build something, those numbers, it's like, okay, well, how much, that's a lot of money. That's a lot of responsibility. How much are you actually making from that? How did you know, like, if I raise this amount of money, or if I do this, or if I transition away from this, I'm going to be better off than I was, when I put in X amount of dollars and I get back out X amount of dollars.
That's awesome. I have this conversation with countless people, right? I tell people, you want $1 billion problem with 1 billion problems, or do you want $1 million company that has no problems? And I don't think there's a right or wrong answer. The difference is that I've never invested in a deal that I didn't have my own money in the deal. So I look at the deal from a standpoint of, am I going to put my money into this? Would I buy this if I had, if I didn't need investors? And if the answer is yes, we move forward. If I wouldn't buy with my own money, I would never risk an investor's dollars. So I still look at it from, okay, if I put 100 in, I'm going to make 150. So now if I put, if I have 5 investors that each put 100 in, that's what it's going to make. And I'm also going to get a piece of theirs. So I don't necessarily back into what $1 billion is going to put in my pocket. I still look at it. How much, if I invest in this deal, how much am I going to net, and how much am I going to walk away with? But there's that added benefit in the syndication model where, as a sponsor and as a deal operator, if I do really well, I'm going to get a piece of the upside on everybody. They're going to do really well. I'm going to do really well. And I'm also going to do better because I'm delivering a finished product. So I don't look at it. I look at it from still, if I put 100 in, what would I make? Would I do that deal if I had $1 million? If the answer is yes, I'll go out and raise it, from, our group of investors and so on and so forth.
So transitioning from the tax liens and purchasing those properties, when did you actually transition to long-term or multifamily space? And what did that first deal look like?
Yeah, so the first deal was in 2014. It was a 48 unit in Columbus, Ohio. It had back tax issues. So coincidentally, it just happened to be in my wheelhouse. Now, we weren't buying the tax lien or anything like that, but that was a condition of sale that those had to be paid. But it was very similar to the heavy lifting that I had done in the smaller deals. So the first deal was 48 units. It was about 70% occupied. About half the tenants were actually paying rent. There was every problem you could possibly think of in the property. There was violations. There was tax problems. We walked into one unit doing due diligence, and the guy had rigged like a PVC pipe, and he was sitting in his chair, and there was water just going into a bucket. I'm like, what's that? He's like, I don't know. It's water coming out of the ceiling. I'm like, and you're okay with it? He's like, no, I don't pay my rent. I was like, oh, okay, fair enough. So I knew going into that property, and the guy bought it for $1.6 million, and he was selling it to me for, $800,000. So I was like, okay, well, someone paid $1.6 million for this thing, and he ran it directly into the ground. But you just saw so many problems. We went into one unit. It was 2 buildings, and there were 6 stacks of units. And one lady had a whole stack, and she had a Walmart. You walked into the unit, and it was clothes and sneakers. I'm like, what? And she was selling that stuff with price tags on it. I'm like, what are you doing in here? And she's like, oh no, they have this. One guy had 6 washer machines in his unit, and he was basically doing everybody's wash. So I'm looking at this this has got an astronomical amount of problems on it. All I got to do is fix it, right? Fix the problems, get paying tenants, and this is not a problem. So we went in there, and that deal needed, and we bought it for about $800,000. We put in about $300,000 worth of work, give or take. So our soup to nuts number, we were in it for under $1 million, under $1.4 million. We sold it for $1.8 million 18 months later. So it was just really easy for me to see that because there was no emotional attachment to it. It was in a great market. It was in Columbus, Ohio. The average rents were well under market. and no one was paying. And the eviction laws are great. You get people out quickly. So we took over. We basically just noticed everybody saying, new sheriff in town, you either pay your rent or get out. We prefer you to get out, because we were going to go in and we were going to fix everything. We did all new balconies and there was down units. It was a disaster. I mean, there's actually a YouTube video that one of the exterminators put online that it was, we opened the door and I was like, there's no shot I'm going in. There was roaches crawling everywhere. And these people were living in the unit like that. So it was broken. I mean, broken was an understatement. And, people say, oh, what was a cap rate? There was no cap rate. The deal was losing money monthly. So we came in, we fixed all the problems. We fired our manager 8 months in because realized he was stealing money too. And we brought in a manager that we still work with now. We actually just fired a manager in Jacksonville and brought him down with us. So we have one management company that we've scaled with. And that was it. I mean, we just came in, we saw the problems. We knew what we had to fix. We fixed all of those. We sold that property for 1.8, and that property has since been traded again at over 2.3. So that guy came in, spent a little bit of money and did really well on it as well. So it's just, we look for broken problems and we know how to fix them. We do those deals really well. So that's what that deal looked like. And I said, if I could do it on 48, let's go do it on 200. And, we've bought 130 unit vacant. We've bought 340 unit vacant properties. So I just did that as, I don't want to say it was a test. It was more or less, this is a great deal. It was 100% recourse loan. It was totally different times, but it was very easy to identify what was broken. There was nothing hiding, and we just had to fix it. And that made life a lot easier.
So what was that starting class of that property and what did it end up with?
So I would say the property, when it was a direct mailer that went out and inevitably got a call back. And it was actually the manager that called me back and said, and I've been talking to this guy for probably close to 6 months. And he said, I have your deal. Let me just call the seller. He wants to sell. He's underwater. He's got 200,000 in back taxes and whatever. So he called me. It was a Saturday afternoon or Friday afternoon. No, Saturday. He said, hey, I'm listing the property on Monday. If you can make me an offer by Monday, I won't list it. I jumped in my car, drove to the property Sunday morning, 10 hours in the car, drove the property, got in my car, drove home with 2 friends. And when I drove there, I said, shit, this is a B-class area. This is gorgeous, right? Like, it was manicured. The property across the street was gorgeous. There was a brand new McDonald's on the corner. I'm like, yeah, this is a very nice class property. Lo and behold, I would say it was a C- C neighborhood. And the property was a D, beyond a D. I mean, it was a disaster. I wouldn't even rate it. And we turned it into a really solid C+ property in probably a C+ neighborhood. Now, the neighborhood was getting a little bit better, and there's a lot more retail over there, and it's getting significantly better. We bought it was probably a little bit rougher, but we turned it into a really nice C+ property in a C+ growing market where someone could easily see that transitioning to a B area and then taking it to that B property. But it was definitely, a C area. And then as we bought it, it was transitioning. So we took a worthless property to a C+ in a C+ area.
So the first thing, and I feel like there's a lot to unpack there. The first thing was you sent out mailers and you get this mailer back. Someone, it's a $1.6 million property, but now someone's trying to sell it for 800. I mean, you said that you couldn't even put a cap rate on it. That would set off a lot of red alarms. And this being your first deal, like, why did you know that this is the right one? And do most people, if they saw something like this, you think that they would just write this off as like, this is a disaster case, I shouldn't move forward. Like, why move forward with this when you could have done, what most people are kind of doing in the multifamily space is you find something that, just needs, just a little bit of work. You just, put a little bit of, lipstick on the pig, and then, you turn around and sell it and you make a little bit of money. Why do something so big like this?
So when I was laser focused when I first started in the multifamily space, I knew exactly what I wanted. I knew I was very capable of raising about $2 million. I knew that I was able to so my first deal, I had a buddy of mine who is still a partner of ours in deals, and my dad and myself all co-signed the loan. So I knew what I could afford. And I never tell people to buy stuff that they could afford because, you may be in an area you don't want to be. But I knew I did not want the cookie cutter multifamily value add deal. Now, listen, in 2014, any deal you bought would have been a ridiculous return. So I could have bought a cookie cutter deal and probably made just as much money or not. But at that point in time, the buyer pool for that deal was not there wasn't a lot of people out there because it was recourse debt. It was a smaller deal. It was very difficult to have third party management. So when I identified my criteria, I was extremely focused on exactly that. I just wanted a major problem that I knew the value was there the day I bought it. I just had to address it. Now, during our due diligence is when we figure out those costs, right? You put some ballpark numbers on it. Like, I know we need new kitchens. I know we need new windows. That stuff's easy. Then you buy it and you realize how much, okay, we got to do this, we got to do that. But during your due diligence, you figure that all out. And I knew from my Marcus days, from the mentor I had, from all of that, I had that process down pat. Our due diligence is super rigorous. We go through every single thing with a fine tooth comb and we find out any problems. And we did have a price reduction during the contract period. And it didn't scare me away because I had done it on a lot of houses in Philadelphia and I had done it on fix and flip. So I knew what it was going to cost to do a unit, right? That, a refrigerator is a refrigerator. It doesn't matter if it's an apartment or a house. It's going to be the same thing. Now, yes, there's super high end refrigerators you put in houses, but that's not what we were doing. I knew I wanted to buy banged up properties in C, B areas that I could turn into, leave a little meat on the bone for the next guy. So when I looked at it, I got excited because I'd been offering on those deals for 6 months and I just was not able to shake anything loose because of pricing and all that stuff. So when I saw that, it didn't scare me. It was exactly what I wanted. I knew that we have a quick 60-second spreadsheet that shows what it is today, what it is stable, and there's a delta. So it comes out as, it's worth $1 million and it's worth 1.8 when you're done. So I look at that spreadsheet and I say, okay, we have a lot of room here. Even if I gutted 48 units, we were going to spend $1 million, right? So I would have been in for the cost. So I could have refied it at that point and kept it or whatever. So there was a lot that can go wrong, and risk adjusted. I saw that the deal at one point sold for $1.6 million. So I knew that time heals all wounds. It would eventually or could potentially be worth that as well. So it didn't scare me away. I actually got excited because I knew that, most people would turn away from that because it wasn't cash flow out of the box, which everyone talks about. I want cash flow day one. And I get it. And that, we look for that as well. But, when things are broken and you could fix them, there's typically more money to be made than if they're working and you tune them up, right? So that's how we looked at it. And that was my criteria out of the box. I did not want to buy a stable 6% cash flowing deal. It just didn't do anything for me at the time. I was 26 years old, 25 years old. So for me, it's, let's put this risk out there. At 25, you can take that risk. So I was like, let's do that now. And let's really put some money in our pocket and really build up this business.
So, you were looking at a deal that most people would be kind of scared off from, but not now. You're doing something that's a little bit, one thing is doing these tax deeds and putting in a little bit of money and doing these yourselves, but now you're asking money from investors. So you might be confident that you might this is what I was kind of doing before, but now you're trying to talk to investors and say, hey, here's my grand scheme. I've never done a multifamily, but here's one that's really beat up. This is what, I think we could double the amount that it's worth, potentially, you're not going to get any money, cash flow. And, there could be a lot more wrong with it. How do you communicate with that? How did you have these investors already? What was that process like with the capital raising?
The best thing I could say, when you start in this business, if you want to raise money, you got to start raising money yesterday. So it wasn't, I found the deal and I just started calling people for money. It was when I made the shift into multifamily, I went through all my contacts, right? I take my phone, I test people. I go to your phone, go A to Z and put a dollar amount next to everybody. That's something that anyone listening to this podcast and hear me say that, every single person can do that once they get done with the podcast, or actually get off the podcast and do it. You put everyone's name A to Z and put a dollar amount, right? And then you'll come up with a bottom dollar, even if it's $5, it doesn't matter. And you'll say, okay, look, $1 million. Now you got to educate that database. You got to educate them so they know you're an expert. So when I first left the finance world and I was doing the real estate stuff, it's an email once a month saying, hey, this is what I'm up to. Oh, hey, I just, now I'm a broker. Hey, you got to keep them up to date. You got to send them articles on why Columbus is a good market, and you got to send them the employment growth, the job growth. And now over time, whether it's a month, 12 months, 5 years, they look to you as to be the expert. Now, everybody knew me as the finance guy, and then everybody knew me as the real estate guy. People still call me today, like, hey, can you come sell my house? I'm like, no, man, I don't do that anymore, but I'll give you a referral. But you want to be known as the expert to your group. And then when the deal comes, they're ready. And I had a rule that I lived by when I was raising money, and I still do, and not nearly as much now with Corona, but I tried to meet 30 new people every single month. So one a day, 30 days, 360 people a year. That's a lot of people to put in your database. And that could be a super sophisticated, high net worth, billionaire, or that could be a new real estate investor that might be in a local market. So you don't have to pick only millionaires, but if you could put a new contact in your database and you could take that database and cultivate it, and they know you're an expert, you're now building that relationship to raising money. And I would, that was 6 months in. I underwrote, I offered on 2 deals a week, regardless. I made sure that I sent 2 offers in every single week on deals. So 6 months in, you're halfway through the year, I've already underwritten, 60, 70 deals. So in month 3, when I was getting close on a deal, I'd send it out to my group and say, hey, look, here's a sample deal. Can we sit down, get coffee, breakfast, lunch, beer, whatever, and let me walk you through this. And then at the end of it is this something that's interested? Yes. If this came across your desk, would you invest in it? Yes. How much? 50. Go back to that list and say, oh, Mr. Jones, I thought he put 20 in. He actually said 50. Update it and realize that whatever you think that number is, you're probably, 50, if not way off. So, if you think you can get $1 million, you probably get 200, 400. But if you do that over time, when the deal comes out and you've educated everybody, they have no reason to say no. And the other biggest thing is you have to present an opportunity. You can't ask anybody for money. You can't call someone up and say, hey, give me your money. It's, hey, check this out. Does it make sense? If it fits your model, let's do it. If not, no worries. Take a look at the next one. So that's what you have to do if you're raising money. You have to start that process now for the deal you come across in 12 months. And if you do that, I promise anyone they'll be successful because their database will be educated. Whether you're raising 200,000 or 200 million, it's still the same process. A $200 million investor is not going to invest on one cold call or phone call or meeting. You're going to have to cultivate that guy over time. So it doesn't matter what they're investing, present a good opportunity and find out what people are looking for. And if they're looking for what your product is and what you're doing, they'll be an investor. You just got to make sure that they have confidence that you're the expert in that class. And it's parlaying. I was in finance. I know how to raise money. I was in real estate. I was doing heavy lifts. And then that education process of why multifamily, why this market, why it's a good deal, and people bite off.
What were some of the common objections? I mean, you said that you had that experience with capital raising. Did you, and anybody could invest in potentially, maybe more of those more maybe safer investments? Was it just because of that relationship that they were willing to invest with you, even though there could be potentially more risk as, the property could go wrong or the market could shift or whatever XYZ reasons? What were some of those common objections you faced?
Yeah. So at the end of the day, listen, everybody gets an investment book and flips right to the back page and looks at the returns. But at the end of the day, they write you a check because they believe in your ability to execute the deal. So I got every objection in the world. This is garbage. You can't do that. The biggest objection, if you can do that, why hasn't this guy already done it? That's the biggest ones you get. And the answer is, listen, his business, he's losing $1 million. Why would he put more money in it? Or he doesn't care. Now it was a South Korean investor and a guy in Hawaii that owned a property in Columbus, Ohio. The guy in Hawaii was a lawyer that was literally robbing the guy from South Korea. The guy from South Korea flew in during our due diligence and spoke to our manager. He's like, what do you mean the property's for sale? He had no idea. So you're going to get every objection in the world. Oh, I don't have the money. Oh, it's not right for me. That's fine. Those objections you're going to hear them, right? To raise $1 million or to raise 500,000, you may need to talk to 100, 200, 300 people. So more often than not, you're going to hear no or a reason or some type of no. But that just means you're one closer to a yes. And you tell people, you explain it to them. You just, hey, here's the situation. I know that it's going to cost me $5,000 to renovate this unit. We're going to get a $200 rent increase. This is our ROI. This is what it is. This property's doing it. This property's doing it. but more people are going to tell you no than yes. But you just got to have all the support behind it. And the biggest objection is, why haven't they done it if you can do it? And that one, maybe that guy's not the right investor or that girl's not the right investor. But if you explain the process and understand and educate people, they invest in the person they feel comfortable with, that knows how to execute, and not necessarily the deal itself when you first start. That's typically what I've found, is that people are investing in you, not necessarily the project. The returns are just a sexy thing that everybody wants to achieve. But at the end of the day, they're giving money to somebody that they believe can execute the business plan and not lose them money.
I really like what you said about, going through your phone and putting a dollar amount. But let's say, you're new into this game. You don't have a lot of contacts. You weren't working at Marcus and Millichap. You weren't a financial advisor. So maybe your crowd wasn't of, super high net worth. How can you grow, or how can you find people that would want to invest if you're just like, hey, I'm hungry, I'm ready to go out there, I've got this deal, but I don't have the contacts or I don't have the connections?
Yeah. So, beg, borrow, and steal, right? So the first thing you do is definitely, it's friends and family, right? And you may have, listen, you're an 18-year-old kid. You might not have a mother, father, uncle, aunt that's got a lot of money. And I get that. And that's how everyone started. And I got the best upgrowing, in the world, right? My parents gave me almost anything I wanted. My parents don't invest any money with me. No one in my family does. And there are some people in my family that have a ton of it, and they won't do it. Do I ask? Yeah, I do, but they don't do it. So I started with, I might have had a better resume, but at the end of the day, it's not what you say, it's how you say it. So having a mentor, having a coach, having some type of credibility, investing in a deal, right? If you're 18 years old and you got $1,000, put $1,000 into a deal, because now that story is different. I own a 200 unit complex. I am an investor. So I know how it works. I know what a private placement looks like. I know what an operating agreement looks like. Now when you go to talk to people, you can easily show them those documents and say, hey, this is what you're going to get. Now you can educate people. So it doesn't hurt writing a check. And then if you do have a mentor or a coach, you can parlay relationships. Hey, I'm working with this guy who owns 4,000 units. He's helped me. Or if you have a really good deal, the bullshit saying in real estate, really good deals always get funded. And that's true. But you might not get what you want, right? It might get funded, but you might get $1. So at the end of the day, bigger pockets, online meetups. Now all these meetups are now all doing it virtually. But if you can get a list of all those people and you just meet 30 new people a month, you can build that list of potential investors. And I'm not telling people, I'm not an attorney or, any of that. I'm not telling people to go into a meetup group, get everyone's name, and then ask everybody for $100,000 the next day. But if you can cultivate a relationship by meeting new people and educating them and making them know you're the expert, it works. Or if you have a really good deal, bring it to a group like us, or bring it to a group that's doing this, or find a group in the market that owns stuff. And you could say, hey, look, I have this deal. It's off market. Nobody has this. You'll get compensated, right? Whether it's, you could be the boots on the ground, whether you can help or just learn, you're going to have to learn. You're going to have to build up an educational foundation somehow. And you're going to have to give some stuff up out of the box. But at the end of the day, you could go through your phone and if you could only put together $5,000, well, maybe you should look for $5,000 deals, right? Start buying some lower hanging fruit, but don't let money ever be the objection, because if there's a will, there's a way. If you find a good deal, this is going to anyone that finds a good deal. Let's listen to this. Bring it to us. Let's sit down. Let's talk. We have no problem with working out a deal with somebody. We're not going to compensate them as just a fee, right? Because that's not necessarily legal. We can integrate someone into our operating agreement as a partner in the deal. That they're going to be the boots on the ground, right? They're going to go collect rent or whatever that looks like. So there's definitely ways to get it done. You just don't let your phone or your database turn, I can't raise money, I can't do this. Nah, do something else, right? Underwrite deals, find good deals, whatever that may look like.
I think a lot of people get into this business and they think, I'm just going to go out, I'm going to find a place, and then, I'm going to be able to make a bunch of money. But, it's not just that. There's one part, which is the operations, the fixing it up, the evaluating, underwriting, and then there's another side, which is capital raising. Do you feel that that it's very easy to do both of those yourself, or did you feel that you had to be able to separate those tasks, and at which point?
Yeah, so that's an excellent question. That's the chicken before the egg, right? This business comes down to two things. It's finding money and finding deals. I am fortunate enough that I'm pretty good at both of them. I like those components of the deal, but I tell people all the time, those are the two wheels that I spin every day: finding deals, finding money. If you can partner and have a partner, it would be easier to delegate, right? You can handle the capital raising, you handle the deals. And when the deal comes in, everybody tries to raise capital. There's nothing wrong with spreading that out when you first start. But at the same time, if I was to refer anyone to do anything, forget finding deals, start with educating and finding capital, because it's a lot easier to find a deal when you have the capital than it is to find the capital when you have the deal. So yeah, you can delegate, and you could have someone finding deals for you. You could have someone finding capital for you, but do what you do best. But if you're going to do it yourself, focus on the capital side of it, because it's a lot easier when you know you can raise 2 million to go buy a $6 million deal than you find a $6 million deal and you can't raise 2 million.
So, as you're scaling though, let's say, this first 48 unit, you had to raise that money. I'm not sure for you, like how challenging that was, but at a certain point, you've gone through your Rolodex, you've gone through all that $5,000 in your phone, and you might feel like you're a little bit tapped out. At which, how do you expand past that point? It's like now you're, let's say you're able to fund this first deal, but now you're trying to do something even bigger. It's like, how do you, find those new investors, do that bigger deal, raise that capital while trying to scale rather than just staying, at the similar size.
Yeah, so that's personal preference. And I tell people all the time, there's something to be said. Bigger isn't always better. Additionally, if you've struck out or you've tapped out your network, one, if you're doing a deal and everybody says no, you might want to go back to the deal and see if there's a mistake, because typically not everybody's going to say no, and or you haven't done a good enough job educating people to say yes. But ways to go about finding new investors, I say, when if you like a market, when you're in the market, go to every networking event, right? Go to Chamber of Commerce and get integrated in that community and explain to everybody what you're doing, because there's investors around every corner. I'm not telling people to knock on their neighbor's door, but when I did my first deal, I raised the money 3 times, and 2 times, investors backed out completely for personal reasons, and I had to raise it for a third time. So, don't knock on your neighbors and say, hey, give me 50 grand. But when you're at a party, you're at a wedding, you're at a, whatever it may be, a sweet 16 or, your cousin's communion, if you're not telling everybody what you're doing and saying, hey, subscribe to my newsletter, or hey, if you're not telling everybody what you're doing, whether it's friends, family, coworkers, you got to talk to every single person and you got to tell them what you're doing. And you got to say, these are opportunities that I bring to people, are you interested? So you could exhaust your network. And I get it, right? If you're an 18-year-old and you only have 10 friends, you guys probably can't put together a $400 million deal, or maybe even $1 million deal, or maybe even a $200,000 deal. But if you can start getting into the networks of people, that's how you do it. It's nothing other than the more people the more people in your database, the more people you connect with. That's key. One thing we do is we try and reach out to every single investor in our database at least once a quarter and have a personal conversation with people. And it's amazing when you talk to someone like, oh, I just sold my business for $2 million. Oh, great. What do you never know who that next person is going to be. So, whether you're listening to the podcast, if you hear someone speaking, reach out, call them. Hey, what's going on? How can I help? How can I add value to you? Maybe your family's got a couple bucks and you're looking to invest the family money, right? So there's a lot of ways to do it, but you got to try it. It's like fishing, right? You throw a lot of hooks in the water. Hopefully one of them catches. It might be going on Bigger Pockets and just being, answering people's questions. It might be going to a meetup event and being an expert in, multifamily properties below 200 units, right? It might be something like that. And maybe that forum doesn't work. Try another forum, right? Get on LinkedIn, get on Facebook, get on Instagram. Don't advertise that you're doing it, but go out there and DM people. Say, hey, how can I help? What can I do? Provide value, and value will come back.
What were some of the best channels that you saw? Like you said, you might go to a meetup group and you might say these are we're going to be talking about multifamily deals under, 200K, but maybe the people that are going to those aren't going to be the people that have that type of money. So have you seen what are some of the channels that best work for being able to find people that are a little bit more high net worth versus, someone that is just trying to do, something a little bit smaller or just trying to, figure this out themselves?
Yeah, no, I would say the best channel that someone could probably get themselves involved with, and it's not self-serving because we don't do it. Coaching platforms are very, very, very good. Like any education platform out there typically automatically puts you in a group of people doing the same thing. And it's an easy way to network, whether you have a deal or whether you have money or whether you network with people in that group. If you're all coming from the same school of thought and you have a good deal, that might be the best opportunity. So when I look at those things and I look at those opportunities, yeah, people don't like writing a check. But when I did the mentor program that I did, and it's no longer around, so it doesn't matter. When I did that, I didn't look at it. The education I got wasn't going to be, I was a broker. I knew that stuff. I knew how to find deals. I knew how to underwrite deals. I looked at it as a country club, right? People join country clubs for the people there and for the networking and for the potential business and the potential relationships. When I look at these programs, I want to see what I'm going to get, because if I can get access to 100 people and I'm in a Facebook community and I know if I present a deal, there are people there that will either buy it from me or do it with me, then that's how I look at those things, right? It's like a country club. That's what real estate is. It's a big country club, whether you're doing tax deeds or multifamily deals or construction. We're all typically in it to help everybody. And at the end of the day, the truth behind it, those forums are probably, to answer the question, they're probably the best because it's like-minded people that you don't have to convince them to invest. They want to invest. They're just looking for the opportunity. But at the end of the day, and this is the thing that people don't necessarily tell people starting, sometimes you just got to get a job and earn more money and maybe wholesale a couple deals, put 100 grand in your pocket and go buy a deal first. At the end of the day, sometimes not everybody can raise money. Sometimes you could be in a Facebook group, a LinkedIn network, a bar, a bowling club, whatever it is. At the end of the day, maybe raising money is just not your thing. And, go get a job, earn 100,000, take 50,000 and invest in a deal. And that's the unfortunate truth of it. Not everybody can do it. Now, I personally believe anyone can do it, right? There are books on how to use LinkedIn to raise money. And there's books on social media stuff. Like anyone can invest in that stuff and do it. But people use excuses of I can, or I don't know, or I'm not good at it. It just, you don't want to do it. But at the end of the day, sometimes you got to look in the mirror and say, hey, maybe raising money is not my thing, no matter what channel I'm in. But I would say the best way to do it is some type of real estate. It doesn't have to be education. It could be just a group of some sort, right? Pay the entry fee and network there, because those are all people that either want to invest or want to find deals to bring investors. So some of them might have more money and they're just looking for an opportunity. Do a joint venture. So I would say that's probably the best forum. It costs some money, but at the end of the day, you pay for what you get typically.
What's been your biggest or the biggest real estate failure, or something that has just really made the hairs on the back of your neck stand up?
Yeah, we were under contract on a 600 unit property in Alabama. It was 2 properties. It was a great deal. It checked off every single box that you could possibly check off. We were about maybe less than a month from closing, and there was a major shooting at one of the complexes, like 800 rounds were emptied into an apartment complex. So I was like, well, that's not good, because now our insurance changed. And now, do I really want to buy that property? And simultaneously, we had another opportunity come across our desk. So we did a cost benefit analysis. We walked away from a $600,000 deposit. We lost $600,000 because we realized the opportunity cost. Let's lose it here because this deal's significantly better. That was not investor money. That was myself and my partner. So I look at it, I say, fuck, if I didn't, it almost seemed too good to be true. It wasn't in an area we loved. It would have been a new deal in a new market. And I look back at that and say, wow, if I didn't lose that, I would have an extra 300 grand to invest somewhere else. But we did not want to be involved in that type of transaction. So we ate it. We bought a much better transaction. So inevitably we'll probably make that back. But I look at that deal, I lose sleep about it sometimes, because it's like, shit, why'd we do it? It was not our bread and butter deal. It's not what we do. We were in a 1031, so we did have a little pressure on us. So we sort of settled. But I look back and say, what if? Now, I typically don't do that, and I don't really lose sleep because, I'll turn the page quickly. But I do think about that transaction. Like the other day, our secretary actually sent me that loss again because I was looking at it and I was like, fuck, like why'd I do it? Like it should have never been done, and we deviated from our plan. That one right there is definitely the biggest kick to the face because there was a big loss. I mean, $600,000 is a lot of money to walk away from. So you got to be real certain in what you're walking away from to execute that it'll make it back. And we feel really good about our new deals. They are going to turn out to be really good. So it's going to be fine. But, that was 2018 and it's 2020 and it hurt.
And when you say that that one was out of your niche, was it just because of the location or did it not require as much work?
It didn't require as much work. It was in Montgomery, Alabama. It was a tertiary market or second tertiary market. Now we've bought in those tertiary markets before, but they've typically been, 100% vacant or 50% occupied, where we're getting them at really good bases and they're super heavy lift. This deal was 98% occupied. The writing was on the wall. All the comps had higher rents, but it really didn't pencil out from a standpoint of what we do, right? It was higher than our normal purchase price. The renovation was lower than what we normally do, but we were still achieving the same return. So we got blindsided by the numbers, and inevitably that's what led us down that path to get $600,000 into due diligence and earnest money and stuff like that. But yeah, it was not in the market we've ever owned in. It was not as heavy lift as what we normally do. But at the end of the day, it just was not the deals that we typically do and do really well.
How would you have handled that situation if you had investors' money into that deal and it wasn't your own?
Yeah, so we would have obviously called everybody and said, "Hey, listen, we lost the earnest money. It's on us." But it's tough to answer because we've never put earnest money down that's not ours. But if we went forward with the deal and the deal didn't work, we do quarterly reporting. We're touching base with investors on a quarterly basis. We don't always give good news, right? There are some times where cash flow is a little bit lighter or there is no cash flow. We just tell people, it's better to say, "Hey, this is what's going on," as opposed to try and skirt around it, right? You skirt around it, you're just building yourself up. If it doesn't get better, you're building yourself up to a disaster at the back end of that. So if it were investors' monies that we lost, we would have explained the situation. And before we would have walked away, we would have called and said, "Hey, this is what happened. The insurance went from 350 to 500. That's going to lower our returns. And inevitably that shooting's going to be on the books for the next 3 to 5 years. So even if we go to sell it, it's going to hurt our sale price." We would have explained the situation. And if investors said, "Hey, let's go forward with it because it still checks off the box," we would have gone forward with it. We had all the money raised and we called investors and said, "Hey, we're not doing this deal. We're losing money because it's not what we wanted to do." Now, if everyone said, "Let's do it," I still probably would have walked away from it. But if it was not my own money, we typically let our investors know what's going on. And not every one of them, but our higher net worth, our higher guys, like sort of our board, we give them play by play and we get their experience and their education behind it. "Hey, what do you think?" And, we lean on them all the time because they've been, they're older guys and girls and they've had a lot more success than we have. So we'll easily go to them and say, "Hey, what do you want to do here?" So it was a lesson learned, a tough one, but inevitably we know, it helped us in contract negotiation going forward. We put things in our contract that would have helped us got that money back. So it was a learning experience, and we've taken that and we've actually grown from that. It cost us some money, but if anyone says they've never lost money in real estate, they're lying, because if you've done enough deals, they don't all work.
You're dealing with, you're handling some very distressed properties sometimes. Are you doing anything like the types of deals that you're able to pull? Are you finding better tax advantages? Are you using like opportunity zones, getting some type of tax credits with these deals? Or are you just finding them just because, you had experience, with rundown places before?
Yeah, so we have one deal that is an opportunity zone. Now we bought it and we told all the investors, "Hey, listen, it isn't an opportunity zone. We can take advantage of it, but that's not why we bought it." We've never used tax credits. We've bought some deals that had some like HUD components and some affordable housing things on it, but we've never used that to go find the deals. We typically, just like the biggest learning experience I've had is you don't want the debt to be the reason why the deal works. You want the deal to work and the debt to just make it better. So we look at all deals from a standpoint of this deal has to operate and work in its bubble. of just being a good real estate deal. I don't want to have to engineer a tax credit or an opportunity zone, because an opportunity zone is a great concept. But at the end of the day, for the most part, some of them are in rougher areas. Now, some of them are in really good locations, but they are in rougher areas. And if they don't gentrify and you are banking on it, then shame on you. Every deal we look at has to work for the real estate it is, or we will not go forward with the deal. So if it doesn't work in its current state, or if it, I don't want to buy a deal that has a tax credit and that's why it's working. I would rather buy a deal that works. The tax credit's a benefit. We did a new construction deal that is in a TIF zone, so it's got tax incentive financing. It's also in an opportunity zone, but that's just icing on the cake. We bought that deal to develop student housing. That stuff's just a benefit. It works in its current state, and whatever happens from it from there is just icing on the cake.
And what would you do differently if you had to start from scratch?
If I had to start from scratch, I would educate my investors better from a standpoint of I would not put up with stuff that we put up early on. And it's a lot easier said than done, because when you're raising money and you need that last 20 grand and a guy says, I'll do it, but I want a little bit of a different pref or a different structure, you may say yes. But if I can educate anybody right now, stick to your guns. It's better to not do a deal than do a deal on someone else's terms. That is one thing that I started doing it at the end of this year. For the deal we just raised money for, I had people say, whoa, this is not your normal structure. And I basically said, listen, this is our new structure going forward. If you want to invest, invest. If not, it's been a really good ride. You're a great investor of ours, and you're always allowed to invest. But this is our new structure. It's a lot harder to educate people after the fact. And if you start doing, a handshake deal with this guy and a better deal for that guy, inevitably it comes back to bite you in the ass. So I would say stick to your guns, set a minimum, don't deviate from it. It's hard to do, but that's something I would absolutely recommend, from anybody. Stick to your guns on what works and don't deviate.
And what question would you ask another multifamily investor, maybe someone that's at a similar size than you, that maybe is doing something a little bit differently, or at that next level where you're trying to go? If you could be asking them any questions, what would those be?
So the biggest question is how you, and this is something we spoke about before we started recording, the fun side of it, right? I know the pros and the cons, but the right structure. And I actually was talking to someone that is bigger than us, and he gave me a really good tip on that fund structure and the real benefit behind it. And that's the stuff that I'm intrigued by. It's like, how can I go raise, we're doing deal by deal. Our typical raise is 4 to 5, maybe $6 million. How can I go raise 20 million and put it to work, as opposed to buying 3 deals that is 6 million in equity? So that's really what I want to know from those guys doing it, how to better execute on that plan so I can integrate it and have the flexibility of capital, as opposed to being stuck in a deal by deal situation.
When, just based off of your experience, growing, and you've grown really well, when is maybe the tipping point, or when does someone say like, hey, we should be looking at, doing a fund structure as opposed to a syndication?
So I think the hardest thing to do in a fund, and this is something we spoke about in a mastermind that I'm in, the hardest thing to do in a fund, you really need a track record. Now, listen, there are people out there that can go raise a $20 million fund tomorrow with no track record. But at the end of the day, for someone to put money into a multifamily fund that you're going to go buy 5 properties with, you got to be able to at least show them that you can execute on that type of deal. Without that, it most likely will be extremely difficult. So I think that getting into deals, whether it's a passive investor, whether it's raising money, whether it's finding deals, if you can put together deals and put together a track record, it will help that domino fall in the future when you want to, go raise $50 million to, blindly put it behind multifamily. So I think having a track record is amazing. It helps. It's not you utterly need it, but I think with it, the doors will open. I've even seen it from the deals we've raised when we first started to where we are today. We've transacted on a lot of deals, and we've gone full cycle on a lot of deals in a short period of time. Just going full cycle on 15, 16 properties out of the 25 we bought, people are like, wow, how'd you do that so quickly? And the answer is, well, we opportunistically sold because we knew what our bigger picture was. Could we have milked every single dollar out of properties? Absolutely. But we don't want to be known as that group. We want to be known as a group that when we sell, people that buy, buy good deals, because that means it's easier to transact in the future. We don't want to take every penny out of it, because it's a lot harder to sell. You're always looking for the greater fool, right? You're always looking for the guy that you don't know, right? Where we've worked really well with a couple of sellers that are extremely notoriously hard sellers to work with in the market. And we've transacted 3 or 4 times with them where we've bought their properties, and simultaneously, we have a couple of people that we would sell a deal off market to, because they're going to pay fair market. And they know that we're not going to squeak out every penny, but at the same time, they're going to buy a deal that there's probably some operational efficiency. There's probably some room left on the bone, because we're not going in and gutting every unit and making it perfect. We're going in and fixing problems and leaving that next level or that next premium for the next guy.
And what's the best way, John, if anybody wants to be able to reach out to you, find out more about you and your company, how can they best do that?
Best way to reach me, my website, you can go to our website. It's Toro, TOROREP.com. There's an investor questionnaire. You can fill that out. Typically, someone from our team will reach out. It'll 9 out of 10 times probably be me. It'll also allow you to schedule a one-on-one with myself or our acquisitions guy. Or you can reach out to me on any type of social media, whether it's Instagram, which it's at John, JOHN_JC, or on Facebook. Reach out, send me a message. I tell everybody listening, don't hesitate to reach out. Anybody has enough time with advance notice where they can give you 30, 40 minutes. If someone has any questions, it could be, hey, can you explain a cap rate, right? I have no problem with taking the time. I've got a lot of help getting to the point that I'm at by my network. So I think that it's only right to give back to, the most novice investor to the most sophisticated guy that wants to put $1 million into a deal. So don't hesitate to reach out. On the website, my email address also, which is john@tororep.com. But either way, reach out. Don't hesitate to, get out to me, and I'm open to talking to anybody.
Yeah, that's really generous, and I think maybe a lot of people, that are listening to this show, or to anybody that sees like they're in those big numbers, they might be, hesitant. They might feel like, oh, that person's at that next level. They won't take the time. I just got to listen to these podcasts to be able to, pick their brains or hear from them. So that's really, really nice of you. Of course, we're going to include all the links in the show notes. But thank you so much, John, for taking the time. And until next time, deal makers, talk to you later. Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.